Alan was 66 years old, $650,000 sitting in a traditional 401k, a net worth of $3.2 million, and a tax problem that was quietly growing bigger with every month he waited. He was retiring at the end of this year, and like most people in his position, smart, successful, financially disciplined, he had no idea that the act of retiring itself was about to pull the trigger on the largest tax bill of his life. The RMD fact nobody puts in writing. Once you hit 73, the IRS forces you to start withdrawing from that 401k, whether you need the money or not, and every dollar comes out as ordinary income, taxed at whatever rate Washington decides is appropriate that year. Alan wasn't 73 yet, but the freight tax train doesn't wait until 73 to leave the station. It leaves the station the moment you stop working and start drawing down. And Alan was about to step onto the tracks. Here's what made Alan's story different from the thousands of people who walk into a single advisor's office every year and never get the full picture. Alan walked into the wealth office, and today I'm going to show you exactly what happened, one specialist at a time, when 5 coordinated experts put their eyes on Alan's situation. Everything under one umbrella, everything under one roof, and not a single dollar out of Alan's pocket to find out what he was missing. Let's talk about what the wealth office actually is, because most people have never heard of it, and the ones who have usually assume it's for billionaires. They're right, it is for billionaires. A traditional family office, the kind you read about in the Wall Street Journal, costs anywhere from $500,000 to several $1 million a year to operate. It's a coordinated team of specialists, investment advisors, insurance advisors, fiduciaries, tax strategists, CPAs, and tax attorneys, all working together, all talking to each other, all reviewing each other's work before a single dollar moves. That cross-validation is the thing most Americans never get. You go to an insurance agent, you get an insurance agent. You go to a financial advisor, you get a financial advisor. You go to a CPA, you get the tax guy. Each one operating in their own lane. Each one solving their piece of the puzzle, without ever seeing the rest of the board. The wealth office changes that. We brought the fractional family office concept down to the level where people with $500,000 or more in qualified retirement assets can access the same coordinated team that billionaires pay millions for, and for their first several appointments, unless we place a strategy that makes sense for them, it doesn't cost them a dime. Here is the RMD fact that changes everything. Most Americans believe their 401k is their money. It is not entirely. The IRS is a silent partner in that account, and that silent partner has never been shy about collecting. Every dollar you contributed went in pre-tax. Every dollar of growth compounded pre-tax. And every dollar you pull out in retirement gets taxed as ordinary income, at whatever rate is in effect at the time. Right now, tax rates are historically low. The question is not whether rates will rise. The question is whether you will be positioned before they do. Alan understood the problem. What he didn't have was the team. Specialist number 1, the insurance advisor. The first specialist to sit down with Alan was our insurance advisor. Not to sell Alan anything, to map the landscape, to look at Alan's full picture. $650,000 in a traditional 401k, $3.2 million in total net worth, retiring at year's end, no pension, Social Security kicking in within a few years. The insurance advisor's job is to identify structural risk. Where is the exposure? Where does a single event, a health crisis, a market correction, an unexpected tax bill, create a cascade that damages everything else Alan has built? What the insurance advisor found: Alan had no protection layer between his retirement assets and the unexpected. No living benefits, no mechanism that would shield his $650,000 from a sudden long-term care event. One health episode requiring extended care could redirect a significant portion of that 401k toward care costs, taxed as ordinary income on the way out at the worst possible moment. The insurance advisor documented the exposure and handed it to specialist number 2, Specialist number 2, the financial advisor. Our financial advisor is a fiduciary. That word matters. A fiduciary is legally required to act in Alan's best interest, not in the interest of any product, any commission, or any company. When Alan walked into the wealth office, one of the first things he asked was, "Are you a fiduciary?" About 50% of the people who come through our door ask that question first, because they've been burned before. They've sat across from someone who called themselves an advisor but was really a salesperson with a license. The financial advisor looked at Alan's asset allocation, his income timeline, his Social Security optimization window, and the projected growth of that $650,000 between now and age 73. Here's the number most people never run. If Alan does nothing with that $650,000 and it grows at a modest rate until his RMDs begin, his forced withdrawal amounts will be significantly larger than they are today. The tax bill doesn't shrink, it compounds. The financial advisor identified the withdrawal sequencing strategy, which accounts to draw from first, in what order, to minimize Alan's lifetime tax exposure, and then passed the file to specialist number 3. Specialist number 3, the tax strategist. This is where Alan's eyes opened wide. Our tax strategist is not a CPA. A CPA files your taxes. A tax strategist builds the architecture so that next year's taxes, and the year after that, and the 10 years after that, look fundamentally different from this year's. The difference is proactive versus reactive. Most Americans spend their lives reacting to a tax bill. The wealth office builds the strategy before the bill arrives. The tax strategist looked at Alan's situation and identified what we call the pre-retirement window, the period between now and when RMDs begin. This window is the most valuable period of tax planning in a person's life. It is also the window most people waste because nobody told them it existed. Here is what the tax strategist found for Alan. There are multiple legal, ethical, and moral pathways to reduce the taxable footprint of that $650,000. Pathways that wealthy Americans have used for decades. Pathways that Alan had never heard of. Not because they're secret, but because his previous advisors were each only looking at one lane of the road. When the tax strategist laid it all out on the table, Alan said something that has stayed with me. He said, "I just didn't know there were so many legal, ethical, and moral ways to do this. No wonder rich people pay such a small amount in taxes." That statement is the entire reason the wealth office exists. Specialist number 4, the fiduciary advisor, the stamp of approval. Here's the rule inside the wealth office that no other firm operates by. Our fiduciary must approve your tax plan before you spend a dime. Not review it, not glance at it. Approve it. Every strategy the tax strategist identifies, every recommendation the financial advisor makes, every exposure the insurance advisor flags, all of it goes through the fiduciary before Alan is ever asked to make a decision. That cross-validation is the safety net. That's the thing billionaires pay for. The knowledge that someone with a legal duty to act in their interest has reviewed every recommendation and signed off before a single dollar moves. Alan sat quietly for a moment after the fiduciary walked him through the review. Then he looked up and said, "So you're all actually talking to each other?" "Yes. That's the whole point. One plan, one team, zero blind spots." The moment the prospect became the pursuer. Here is what happened after Alan's appointments were complete. Alan didn't need the CPA. He didn't need the tax attorney. Those specialists exist on a need basis, and Alan's situation didn't require them. What Alan needed was the coordinated picture, the 4 specialists, working together with the fiduciary signing off at the end. And Alan was so energized by what he found, so relieved that the answers existed, that the pathways were legal and ethical and available to him, that he started chasing us. He called, he followed up, he was virtually knocking on our door to move forward, because that's what happens when someone finally gets the full picture after years of operating with pieces. The prospect became the pursuer, and that is the most powerful trust signal in financial services. Here's the thread that connects Alan's story to yours. You have spent decades building what you have, and if you have $500,000 or more sitting in a traditional 401k or IRA, the freight tax train is coming. Not maybe, not if tax rates rise. The train is already on the tracks, because the deferred taxes inside that account are not a question of if, they are only a question of when and how much. Most people will face that moment alone, with one advisor, in one lane, looking at one piece of the board. The Wealth Office gives you the whole board. Under one roof, under one umbrella, every specialist coordinated, every recommendation cross-validated, every strategy approved by a fiduciary before you commit to anything. Alan found out what he was missing. The question is whether you will find out before the train arrives or after. Here's your mirror moment. If you are Alan, if you have $500,000 or more in a traditional 401k or IRA, if you are approaching retirement, if you have a tax problem growing quietly in the background that no single advisor has ever fully addressed, you are sitting exactly where Alan was sitting. Not because you made mistakes, because the system is designed to give you one expert at a time, one lane, one piece of the board. Below this video is a link. Book a private one-on-one strategy session. We will sit down with your numbers, your IRA, your income picture, your timeline, and we will show you which specialists you need, what they find, and what your options look like before the freight tax train reaches your station. You have spent 30 years building this. Spend 30 minutes finding out what your solo advisor never saw. Rescue, reclaim, retire richer.